Hi friends, welcome to the channel JAIIB and CAIIB Made Simple. This is our theory of unit number 2 of CCP and the chapter name is credit policy. So before diving into the chapter, let's see what are the topic which we have to study. First of all, we will see the objectives, then we will see the introduction, policy framework, content of the credit policy, priorities, role, MIS and review and conclusion. So these are the 7 topics which we have to see and we will cover this entire 7 topic in 3 parts. This is the part 1 lecture. So our methodology of studying will be the same. We will first of all see the concept, and after concept we will see the key ideas, some important formulas or rules that we need to keep in the mind, and finally some examples and do some MCQs also. So this way we are going to cover each and every topic. So let's get started. So today we are starting with our first topic, that is our credit policy introduction. So this is the backbone of safe lending in any bank. You know, credit policy is the backbone of safe lending in any bank. What is credit policy? You can think of this credit policy as, rule book. You can think of it like a rule book that tells bank employee, right? It tells bank employee that how to give loan safely. How should they give loan safely? So it contains some do's and don'ts, risk rule, approval guideline, so that every loan decision is correct, legal, safe and profitable. See, some words are there. Correct, compliant, that means legal, right? Low risk means safe, and profitable, right? So this is a kind of rule book that every bank employee has to follow, right? It contains some do's and don'ts, and also and some approval guidelines, so that every loan decision is correct, legal, safe and profitable. So a quick formula or rule to remember is that good credit policy is the sum of compliance, risk control, quality portfolio and profitability. Let me give you one example. For example, before approving any term loan, a bank officer checks this policy to make sure that everything is as per the rule. Now the next thing is, what is the credit function of a bank? You know it very well, that it simply means all the activities related to giving the loan, right? Activities related to giving the loan, like it may include, cash credit, it may include CC, it may include OD, it may include term loan, discounting the bill. You can see now, cash credit, OD, term loan, bill purchase discounted, LC, bank guarantee, letter of credit. So this is called, credit function of a bank. So a simple rule is that, credit delivery includes 2 things. Credit delivery includes branches and alternative channel. Traditionally, branches are the main loan delivery point. If you look at the main loan delivery point, it is none other than the branches, right? So I hope this is clear. So just now what we have discussed, that friends, let's talk about the credit function of a bank. So what is the credit function of a bank? It simply means all the activities related to the giving the loan, right? Like cash credit, overdraft, term loan, bill purchase discounted, LC, bank guarantee, etc. So the simple rule is that credit delivery is equal to branches plus alternative channel. So credit delivery includes 2 things. The first thing is branches plus other thing is, other channel. Branches plus other channel. These 2 combined together includes credit delivery. Traditionally, branches are the main loan delivery point, right? So this is the point. So let's do some MCQs based on what we have discussed. Before that, this is the master tip that we must keep in the mind, that a strong credit policy is the backbone of safe, profitable lending. It keeps risk low and decision consistent. So that is the importance of having a strong credit policy. So what we have discussed just now, we have discussed that credit delivery includes 2 things, branch system plus other channel, and second thing is good credit decision. We have to follow the guideline plus regulatory compliance. So just remember this CGQP, which is compliance, guideline, quality, portfolio and profitability. That's called CGQP, compliance, guideline, quality, portfolio and profitability, right? So let's have the question. The first question is, what is the main purpose of bank credit policy? Increase number of customers, provide marketing guideline, ensure correct, compliant and profitable credit decision. And last option is improve branch layout. So option number C is correct. Ensure correct, compliant and profitable credit decision. That is the main purpose of credit policy. Next question is, traditionally which unit is the primary delivery channel for credit? So which unit is the primary delivery channel for credit? Head office, ATM, branch and call center. Obviously, the correct answer is branch, right? The correct answer to this question is branch is the primary delivery channel for credit. Traditionally, branch is the main delivery unit of credit in a bank. Please remember it. Now, let's look at the credit policy objectives and component. So, let's first of all talk about the objective of credit policy. Why does a bank follow a strict rule while giving loan? Right. So, the question is, why does the bank follow a strict rule while giving loan? So, why can't they lend just freely? Because, every bank need a credit policy. So, this credit policy, you can think of them like, safety belt. You can think of them like, safety belt that keep lending safe, steady, and profitable. Safe, steady, and profitable. Right. So let's look at the objective of the credit policy. The main objective of the bank credit policy is balance. Right. Just remember, balance is the main objective of the credit policy. So when I say balance, it means what? Bank cannot give too many loan blindly. Right. Bank cannot give too many loan blindly. And also it cannot stop lending completely, right? So the credit policy helps the bank maintain a healthy balance, right? As you can see, they have written, it helps maintain a healthy balance between what? Between the credit volume. Credit volume is how much the bank lend, earning means how much profit it earned, asset quality, how safe and NPA free the loans are, and finally we have the regulatory, under the regulatory guidelines. So healthy balance between credit volume, earning, asset quality. Credit volume is how much it can lend. Earning means how much profit it earned. Asset quality means how safe and NPA free the loan are. So a good credit policy allow the bank to grow steadily without increasing NPA. So if we have a good credit policy, what will happen? It helps the bank to grow steadily. The bank can grow steadily, right, without increasing NPA. NPA does not increase. So the formula is very simple. Healthy credit policy is balance, and balance includes three things: volume, earning, and asset quality. These three things are under the balance. Volume plus earning plus asset quality. So one example is here that suppose a bank increases its loan book but still keep NPA low, right? So a bank is there, increases its lending but still keep the NPA low. This is exactly what credit policy aims for. This is exactly what credit policy aims for. Bank increases its loan book but keep the NPA low. So meeting the balance, maintaining the balance. The second part is, loan policy. Loan policy you call it, or you call it essence. The loan policy is the bank internal system, right? What is the loan policy? This is the bank internal system, right? What it does, this is the bank internal system that tells how to sanction the loan, right? How to manage them and how to monitor the risk. So three things are there: sanctioning, managing, and monitoring, right? So loan policy tells the bank how to sanction the loan, how to manage them, how to monitor the risk, right? Please remember it. So this policy ensures that loan decisions are taken with commercial prudence, as you can see. So this credit policy, loan policy we are talking about, this loan policy ensures that loan decisions are taken with commercial prudence, right? Ethics, a strong ethics, and a strong sound business judgment. In simple word, we can say that loan policy include, right, how to give loan responsibly and safely. Two words we can say: responsibly and safely. How to give loan responsibly plus safely. That is what loan policy ensures. Okay. So the easy formula to do is that effective loan policy is the sum of three things. The first is sanctioning plus management plus monitoring of the credit risk. Sanctioning, management, and monitoring of the credit risk. Please remember these three when added together, then we have the effective loan policy. So let's do one example. A loan officer checks the borrower financial risk before approving a business loan, right? So a loan officer assesses the risk before approving a business loan. Please remember it. So what we have discussed is that credit policy is the bank safety belt. It controls risk, protect profit, and ensure disciplined lending. Now let's summarize the key point which we have covered. First thing is that credit balance, healthy volume, good earning, and a strong asset quality. So three words, please remember it: volume plus earning plus asset quality. Volume plus earning plus asset quality. When combined together, that gives you credit balance. Second thing is credit risk control, which includes sanctioning, managing, and monitoring. So remember this 3S rule. 3S rule says what? Steady, sustained, safe expansion. Steady, sustained, safe expansion. Please remember it. So let's do some MCQs based on what we have discussed. The first question is, what is the primary objective of a bank credit policy? This is the question. What is the objective of a bank credit policy? Increasing number of branches, maintaining balance of credit volume, earning and asset quality. Exactly. This is the primary objective. We have to maintain the balance of what, volume, earning and asset quality. Right. Volume plus, earning plus, asset quality. So maintaining the balance between these three is the primary objective of a bank credit policy. Second question is, which of the following is included in the bank credit policy? What are included in the bank credit policy? ATM cash loading policy, investment portfolio guideline, customer acceptance guideline, marketing guideline. So what do you think? Yes, inside the bank credit policy, customer acceptance policy is included. So credit policy includes some guidelines like, customer acceptance. It includes KYC. It includes due diligence and lending ones, not ATM loading or marketing rules. Right? Please remember it. Now friends, let's shift our focus to the credit policy framework. So when a bank give loan worth crores, how does it make sure that decisions are safe? The answer lies in the credit policy framework. Yes, this is what it ensures that whatever loan the bank has given, it ensures that, decisions are safe. So this credit policy framework is a rule book that keeps the lending disciplined and risk free. So this is a kind of rule book. Just remember it. This is a kind of rule book that keeps lending discipline, and lending also keep the lending risk free. Right? Please remember it. So now let's look at the policy framework. What is a policy framework? Please understand. So every bank has a written document that is called credit policy. Right? Every bank has a written document that is called credit policy. Right? So the policy is approved by the bank board, and the policy is not approved by the branch officer. Please remember it. Who approved the policy? Obviously, bank board approved the policy. Right? It is not approved by the branch officer. So this policy clearly defined how much risk the bank can take. So it outlined the risk limit and what rule must be followed and what procedure officer must follow during the loan approval. So these things are being ensured. Right? So the policy is approved by the bank board. Question may be asked, who approved the policy? Please answer. The policy is approved by the bank board. Branch officer has no role in approving the policy. And what does it define? That it defines the risk limit, how much risk the bank can take, what rule it must be follow, and now it also discuss the what procedure officer must follow during the loan approval. So in short, we can say, credit policy includes three things: risk limit, regulatory compliance, plus clear procedure. So when three things combine together, it becomes the credit policy. Right? So please remember, it ensures that, bank stay within safe risk level and avoid mistake that could affect the profit. So it ensures that, bank stay within safe risk level, right, and avoid mistake that could affect the profit. So one example I can give you, suppose a loan proposal crosses the allowed risk limit. The officer cannot approve it. They must seek higher approval, right? So let's suppose that loan proposal crosses the allowed risk limit. So the officer obviously cannot, because the risk limit has been proposed by the, it is proposed by the board of directors. And if the loan proposal crosses the allowed risk limit, officer cannot approve it. They must seek higher approval. That's the point. So that is called, credit risk framework, credit policy framework. This is a rule book for lending discipline, for risk-free discipline. It is approved by the bank board. Please understand these points. Now, deviation and approval, very, very important. Sometimes, a loan proposal may fall outside the policy rule. Sometimes it may happen that, a loan proposal, it may fall outside the policy rule. It may fall outside the policy rule, right? It may happen. So this is called, deviation. This is called deviation. Please understand. So any departure from prescribed risk limit must follow a specific procedure. So that's called deviation. So the bank cannot ignore such deviation. This is a formal process. Bank cannot ignore such deviation. So there is a 3-step easy guideline. What is the 3-step easy guideline? First of all, you have to handle deviation. Handling is first of all identify, then justify, and then get approval. Identify, justify, and get approval. That's the point. That's called, deviation handling. So, for example, identify means what? Identify means officer detect that proposal is outside the policy. Officer detect that, detect that proposal is outside the policy. Justify means what? Officer explain why deviation is needed. Right. So I'm taking about deviation. So if you have any deviation, first of all, we have to identify. First of all, detection is very important. That this proposal is outside the policy, credit policy. Then you have to justify that why deviation is required, why deviation is needed, and after justification, you have to take approval. So higher authority, right? Higher authority, or we call it credit risk committee, or sanctioning authority, right? So they must approve it. So this system prevent officer from taking unapproved high risk exposure. So identify, justify, get approval. That is the process that they have to follow, right? So one example they have given you, that suppose a borrower has lower rating than required. So the officer must get a special approval before sanctioning the loan, right? This is a very good example to understand this concept. Suppose there is a borrower, right? And a borrower has a lower rating. So as you can see, they have mentioned that the borrower risk score is below the policy level. If the borrower risk score is below the policy level, so the officer must get a special approval before the sanctioning the loan. So what we have discussed so far, so whenever in doubt, we have to follow the policy, and whenever outside the limit, seek approval. That is the golden rule of safe lending, right? So let's revise what we have covered so far. So I told you that risk governance include risk limit plus procedure plus approval layer. Then updated policy includes new product plus market changes plus regulatory update. So RPA, risk limit, procedure and approval. This way you can remember RPA, risk limit, procedure and approval. Let's apply the concept which we have discussed to some MCQs. Who approve the credit? So first of all, CPC, who decide the loan rule of the bank and who makes sure that those rules are actually followed. So here we are talking about rule book and following it. So who decide the rule book of the bank and who decide that those rules are actually followed. So we will understand two important pillars of credit governance. The first one is the CPC. CPC is Credit Policy Committee. Second is the CRMD. So let's start with the CPC, Credit Policy Committee. So this is the higher level committee in every bank as per the RBI guideline. As you can see, high level committee as per the RBI norms. And the committee has some senior most leader, like it includes chairman, right? It includes CEO, or it includes executive director. So some word they have mentioned: chairman, right? CEO, and ED, executive director. So what does the CPC do? CPC is like the brain of bank credit system, right? It is just like brain of the bank credit system. It decide what the bank credit policy will be, right? Setting the credit policy, what procedure must be followed, what kind of risk the bank can take, what are the prudential limits for large loan, whether the bank is following RBI, these are the points, whether the bank is following RBI norms or not. So in short, we can say, CPC includes combination of three things. The first one is the policy, credit policy. Second is the procedure, and third is the risk control, right? So when three combined together, that's called CPC, right? CPC is Credit Policy Committee, policy, procedure, and risk control. So one example I can give you, that CPC approved new limit for how much a bank can lend to a large corporate group, right? So CPC approved new limit, new prudential limit for how much bank can lend to a large corporate group, right? So that's called CPC. Second thing is CRMD. What is CRMD? Credit Risk Management Department. So if CPC is the brain, then CRMD is the bodyguard. So this way you can think of it. So if you think that CPC is the brain, right? In that case, CRMD is the bodyguard. Please understand it. Okay. So it ensures that officer follow the rule that CPC has made. So CRMD ensure that, officer follow the rules. Who have made the rule? CPC has made the rule, and CRMD ensure that officer follow those rules. So remember, it is an independent department, as you can see, and it means that it works separately so that risk decision remain unbiased. It works separately. Why it works separately? So that risk decision remain unbiased. That's why it works separately. Now, what does the CRMD do? It check the credit risk before loan are sanctioned, right? So it check the credit risk before sanctioning the loan. It check the credit risk. It monitors the loan quality. As you can see now, property evaluation, credit risk checking, track sector where the risk is rising, evaluate the loan portfolio, provide MIS report, right? Ensure that all the risk rules and prudential norms are followed. So in short, we can say CRMD is a combination of three things: risk assessment, monitoring, and corrective action, right? So one example I can give you that CRMD notices rising default in the real estate sector and advises the bank to reduce exposure to it. Because CRMD identify that, in this real estate sector, there is a risk is rising, default is rising. So that's why it advises the bank to reduce the exposure. So that is what CRMD does. It tracks sector where risk is rising, evaluate the loan portfolio, provide MIS report, and ensure that all the risk rule and prudential norms are being followed. So risk assessment, monitoring, and corrective action. All these things are done by CRMD, and this example clearly indicate what. So what we learned from this discussion is that, CPC make the rule, CRMD enforce them. Together they protect the bank from credit disaster. So that's the way of learning. In the entire CCP lecture, we are first of all covering the concept, then we cover the formula or rules, we cover the key ideas, we cover the examples, and finally master tips. So all these are, are there. So that same thing repeated 2 to 3 times, so that it become very crystal clear to you, right? So if you want such kind of lecture for the entire syllabus, because in the YouTube you are getting only few lectures, only the first part of the lecture. If you want to get the entire lecture, you can WhatsApp me on this particular number. We have started the CCP session and providing you units day by day on day basis. So now what we have discussed so far, let's just see the formula flashcard. So credit governance include 2 things, CPC, which is regarding the policy, and CRMD, which is regarding the executions, right? So CPC for policy, CRMD for executions, please understand it. And then we discuss that, risk oversight means monitoring plus MIS plus portfolio evaluation. So when monitoring combined with MIS plus portfolio evaluation, that's called risk oversight. And memory trick is that CPC is the brain, CRMD is the bodyguard. This way you can remember it. Now one question I may ask you, who head the CPC? Who is the head of CPC? Branch manager, chairman, CEO, ED, senior auditor, loan officer. So correct answer is chairman, CEO, ED is the, he head the CPC. CPC is head by the chairman, ED and CEO. Next question. Which department is responsible for enforcing parameter and monitoring the credit risk? The correct answer is CRMD, Credit Risk Management Department. So they ensure, friends, the next question, the next concept that we have is, what exactly is written inside a bank credit policy? What does it try to achieve? Right, that is what we are doing to discuss. Purpose and the content of credit policy. What exactly is written inside? What is the content? And what it try to achieve? That is the purpose. Let's break it down in the simplest way. Purpose and objective. First of all, when a bank creates its credit policy, the first thing it writes is the purpose. Basically, answer the 2 questions. So, this purpose, it answers the 2 questions. What are the questions? That what does the policy wants to achieve? What does the policy wants to achieve? Second thing is, what area will it cover this year? What area it will cover this year? So see thing, purpose includes what policy seek to achieve and what it covers this year. To decide this, bank reviews several things. Bank review the current economic situation, the last year bank performance, the business mix and how lending behaved. So bank review all these things. The economy, regulatory concern, bank performance, business mix. So bank review all these things, right? This helps set the tone and direction for the policy. So bank reviews economy, regulatory concern, bank performance, business mix to set the tone for the current year policy. Simple formula is, policy includes purpose includes what policy seeks to achieve, means what it want to achieve and what it contains. When both of them combine, this give you the purpose. What policy seeks to achieve and what it contains. That's the purpose. Simple example I can give you that before setting the credit limit, the bank check how last year loan book performed, right? So before setting the credit limit, bank review the last year loan performance. That's the point. Now the second part is the objective statement. So after purpose comes the objective. So purpose is that what policy seeks to achieve, right? So before setting the limit, bank check how last year loan book performed, right? So what it contains, what policy want to achieve. And after purpose comes the objective. What is objective? Objective is the clear set of things that bank want to accomplish through the credit policy. So whenever I say objective, so it means, clear list of things that bank want to accomplish, right, through the credit policy. Clear set of things that the bank want to achieve through the credit policy. So what the objective focus on? It focus on asset quality. Asset quality means, keeping NPA low. Safe growth. Safe growth means expanding without taking excess risk. Risk adjusted return. That's called RADR. which means, earning goods return for the risk taken. Market share, which means expanding presence in the market. Priority sector lending, meeting RBI mandated target. So these are the key ideas. That is what it's focused on. Objective focus on asset quality, safe growth, risk adjusted return, market share, priority sector lending. Right. Simple formula is objective means quality, growth, risk return, market share, and priority sector. Right. So one example I can give you that a bank increases MSME loan to meet priority sector lending target. Obviously, this is a clear example. Why it increases the MSME loan? Right. So that's the point. It focuses on asset quality, safe growth, risk adjusted return, market share, priority sector lending. So what we learn from this is this, that every credit policy has two pillars. Why? But that means the purpose. And what? But that means the objective. Master these purpose and objective to tackle any exam question. Purpose and objective. So what we have discussed, that asset quality goal is maintenance and improvement. That's the goal of asset quality. Balanced growth means, growth in asset and plus risk management. So these two things ensure balanced growth. And then just remember purpose, objective, growth, risk, and market share. This is the hierarchy. Now the question is the purpose and the content portion of the credit policy usually include HR policy, review of economy and regulatory concern, social media strategy, staff welfare scheme. So this particular section, when we talk about the purpose and the content, it explains what the policy aims to achieve. Right, two things I told you, a purpose and objective. What the policy it aims to achieve, and include analysis of the economy, regulation, and past performance. So B is the correct one. Which of the following is not listed as the key objective of the credit policy? Very good question. Option is maintaining asset quality, achieving market share, risk adjusted return, increasing staff salary. The staff salary has nothing to do with credit policy. So A, B, C are correct. So option number D is wrong. That is when lending authority. So friends, a bank cannot give loan to everyone, everywhere, at any price. So how does it control what to lend, whom to lend, who can approve what? Let's decode two powerful concepts. The two powerful concepts are additional objective and lending authority. So we are going to discuss how the bank control what to lend, whom to lend, who can approve what, etc., etc. That's called, additional credit policy objective. Apart from the main objective, every credit policy also contain extra guideline that keep lending disciplined and risk-free. So apart from the main objective, every credit policy contain extra guideline. Just wait a minute. Every credit policy contains, extra guidelines, and this extra guideline keep lending disciplined and risk-free. So what are the extra guidelines? So it includes rules about, what proportion of asset the bank should hold, right? What proportion of the asset the bank should hold, which sector the bank should focus on, as you call focus area. Then minimum credit score required for borrower, some which exposures are banned, some pricing guideline, how the loan pricing should be decided, right? So these are the area that they focus on. So it includes the rules based on what proportion of asset the bank should hold, right? Asset mix target, focus area, minimum credit score, banned exposure, and loan pricing. Simple formula is, if we talk about the objective, asset mix, focus area, target, credit score, banned asset, and pricing approach. So these rules ensure the bank does not take unnecessary risk and grow in a balanced way. So let me give you one example to understand it. So if the customer credit score is below the set limit, let's suppose that the credit score is below the set limit. So what will happen, the bank reject the loan as per the policy. Bank will reject the loan. Right. So that's the point. If the customer credit score is below the set limit, the bank reject the loan as per the policy. That's the point. Now, the next point is lending authority and responsibility. Bank follow a very structured hierarchy when deciding who can sanction how much loan. Right. So, bank follow a structured hierarchy when deciding who can sanction how much loan. So the authority from the top level to the bottom level are like this, right? First of all, we have the board of director, then we have the credit committee, then we have the officer at different level, right? So this is how, lending authority work. Board of director, what does the board do, So board does see the highest lending power. Board see the highest lending power. Then credit committee, what it does, it approves the medium or large proposal. Medium or large proposal. So board of director, set the highest lending power. Credit committee approve medium or large proposal, and officers at different level approve a small loan within their delegated limit. So simple formula is lending authority is like this: board power, committee, and officer power. This ensure discipline and prevent any one officer from giving excessively large loan on their own. So one example I can give you: a branch manager approve a small loan within his limit. Larger loan must go to the higher committee. So that is what we have discussed, that lending authorities and responsibility. And I told you it is divided into three levels, right? Board of director, credit committee, and officers at different level. So what we have discussed, always track two things: who can sanction a loan and how much they can sanction. Always these two things should be tracked. So these are the exam gold point: lending power. So some formula which we have discussed, let's discuss. So what we have discussed, asset mix target is equal to percentage fund based plus percentage of non-fund based. And lending hierarchy, board, committee, officers, right? So for on the top we have the board, and then we have the committee, and from committee we have the officers, right? Please understand. Now let's do some MCQs based on what we have discussed. Which of the following is an additional objective of the credit policy? So increasing employee bonus, setting cutoff credit score for new asset, managing ATM cash, designing marketing posture. So correct answer is B, setting cutoff credit score for new asset. Additional objective include credit score limit, asset mix target, focus area, band exposure, pricing rule. Next question: lending authority in a bank is delegated through government officer, randomly assigned, or staff? No, actually delegation is like this: board, credit committee, and officer hierarchy. This is the correct one. Now friends, credit policy: denial, portfolio mix, loan type, and appraisal standard. Let's understand it. So why do bank record rejected loan? Why can't a bank pull all its money in one booming sector? And how does a bank decide if the borrower is a strong or weak? Let's break down the four powerful part of any credit policy, right? So we are talking about the four powerful part of the credit policy. Let's understand. So the first thing is credit denial and recording procedure. Let's discuss it. Whenever a bank rejects a loan, it must record the reason in writing, right? It must record, right? Whenever request is rejected, it must record written record of such refusal. Why? Because written record ensure transparency, the no favoritism, no biasness, proper audit trial, and compliance with regulation. That's why whenever a credit request is rejected, written record is required for transparency, no favoritism, proper audit trial, and compliance with regulation. So the simple formula is denial should have proper reason plus written record. Just remember, these two added together becomes denial. One example I can give you: a declined home loan must be recorded in the bank system with clear reason. Next thing is portfolio composition, concentration, and diversification limit. So